This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com. Statements of cash flows. Now, in the previous session, we talked about the statement and looked quickly at the pro forma on page 88. This session, we're going to go through a full example on page 89 and actually prepare a full statement. But remember what I said before, you can't obviously be expected to prepare a full statement. It'll only be an extract. But because it could be any little bit of this, working through this example should cover everything you could possibly see. So let's have a look quickly what we're given. We're given the balance sheet, statement of financial position this year, 2008, and last year, 2007. It looks fairly normal. We'll look through the individual figures as we need them. We're given an income statement for the year 2008. The final profit note is 61,000. There's a little bit of extra information. Admin expenses include depreciation. During the year we've sold some non-current assets and we've paid some dividends. And our job is to prepare this statement. And of course, the net change in the cash balance should explain why the cash has fallen from last year 64,000 to this year 45. So there we are. However, before we actually write up the statement, we'll need to do two little bits of workings. And this is actually, the first bit certainly, is good revision of something we did earlier, in that one thing we're going to have to do here is sort out the non-current assets. Because on the balance sheet, non-current assets have changed from 410,000 up to 545,000. Those figures surely are the net book value, the written down value of the non-current assets. And there are several different reasons why that balance could have changed. And it's very important we sort out why is it changed, have we bought assets, have we sold assets, and so on, because we'll need the figures in our statement. So let's have a go. And the easiest way, I think, it's only workings, appreciate, but is to do the workings in a little T account. I'll do a little T account for non-current assets. And what do we know? We know the balance brought forward, so at the beginning of the year we had a debit balance of 410,000. Several things could have happened during the year, which we'll sort out in a moment, whereby we debit with credit, but we do know that at the end of the year, whatever's happened, we've ended up with a balance at December 08 of 545,000. And so we must have carried forward 545. Well, our job is to fill in the missing figures. What's happened during the year? And think for yourself, why will that balance have changed? There are several reasons. One reason is we could have bought more assets. If we bought more, or if we've had acquisitions, surely it would have increased the non-current assets. We'll fill in figures shortly. Just let's try and sort out why it might have changed. Why else might it have changed? It could be that we've sold some. Surely if we've sold some or we've had disposals, the balance would fall. Another very obvious reason, even if we hadn't bought or sold any, since the figures here must be the net book values, surely the value would have fallen by virtue of any depreciation. That's really only one other reason why they might have changed. Yes, the other reason, we could have had a revaluation. If we've revalued, that alone could have been the increase. So there are the possible reasons, but let's here sort out what we know. If you look at note 1, below the income statement, it says administration expenses include depreciation. So we know the depreciation figure. It's 40,000. We can fill that in. What about note 2? Note 2. During the year there have been sales of non-current assets for 30,000. So that's the cash we've received. The assets sold had originally cost 50 and the net book value was 20. Be careful here. Remember, the balances we're looking at must be the net book values. We started at 410, and therefore if we sold any, we must take out the net book value. So take out the net book value of 20. What else? Well, there's nothing else in note 2, and note 3 is completely separate. What else can we look at? Well, what about the revaluation? Revaluation, there's no mention of one, but remember, if we had have revalued, any profit on revaluation would appear as a revaluation reserve on the balance sheet. Look back to the previous chapter if you need. And so is there a revaluation reserve? No, there isn't. And so in this one there's been no revaluation. And so finally the missing figure must be the purchases, the acquisitions during the year. So what is the missing figure? The credit side adds up to 66,05,000. The missing figure therefore is, I better use my calculator, 605 minus 410, 195,000. Now we are going to need that for our statement. These workings were necessary. And it's not wasting time here, it is good practice, because all by itself you could be asked something like that. That is revision of the earlier chapter, effectively the chapter on depreciation. Quickly, while we are there, of course, and you'll see later another figure we will need, those disposals, they had a net book value of 20 and we actually sold them for 30, and so there is a profit on disposal the selling price 30,000, the net book value 20, the profit on disposal is 10,000. And again, I'll explain why when we come to it, but we are going to need that figure for our statement. Alright, one more bit of workings. We're going to have to sort out at the tax. If you look at the balance sheet, at the end of last year we were owing 30,000. At the end of this year, 2008, we're only owing 20,000. We need to sort out why it's changed. Again, I think the easiest, I'll do it as a little T account. The tax liability. At the beginning of the year we were owing 30, so we had a credit balance of 30. We'll check in a minute what's happened during the year, but at the end of the year it tells us we end up with a balance of 20. Well, what's happened during the year? Well, surely two things will have happened. First of all, there'll have been a charge for the year. And we know what that is from the income statement. In the income statement, the tax charge for this year is 39,000. And that would mean more money owing, of course. If we hadn't paid any, we'd end the year owing 69. However, the other thing that'll have happened is clearly there will have been cash paid, credit cash, debit tax. How much cash have we paid? Well, surely that must be the missing figure. And so the missing figure, we must have paid 49,000. And again, we are going to need that figure for our cash flow statement. Okay, well now we've done those two bits of workings, we can go straight into our statement. Check the figures, watch very carefully what goes where, because again, that's what you'll be tested on. So, statement of cash flows. I've said you must learn the three headings, and the first heading is cash flows from operating activities. And I said before, what we really want here is the cash generated from our profits. And so we start off, first of all, with our operating profit. From the income statement, how much profit did we make? By operating profit, we want the profit before tax. We'll deal with tax separately. We also want the profit before any interest. That's not actually part of our operations. We'll deal with it separately. So profit before tax is 100. If we add back the interest, the operating profit is 101,000. However, why didn't that give us cash of 101,000? There are two types of reasons. The first reason is that in arriving at the profit, there are going to be various non-cash expenses. The most obvious, and the one that you'll see in your exam certainly, is depreciation. In arriving at the profit, we charge depreciation, but of course depreciation doesn't mean we're actually paying out cash. And so we need to adjust for it. We'll add back the depreciation charge always. Of how much? Well, from note 1 it was 40,000, because again that wasn't a cash expense. On that alone the cash we've had would have been higher. Before I do a total, the other one here is the profit we made on the sale of non-current assets. Now, we've sold non-current assets. I know we've received cash, and we are going to show the cash received, albeit we'll show it somewhere else. But the cash received was 30. In the income statement, though, we'll have shown the profit on sale of 10, and the profit itself isn't a cash figure. And so because our profit includes 10,000, we will deduct the profit on sale to get a cash profit. Now again, those are the only two adjustments of that type you'll ever see in paper F3. In later exams there can be more problems. Learn them, but at the same time be clear of the logic. And so those adjustments were for what you might call non-cash items. And after adjusting, we get a total of what? 131,000. All right, well that's one reason why we needed to change the profit figure, but the other reason is to do with things like receivables. That you see, in our income statement we'll have brought in all the sales for the year, whether we've received the cash or we haven't. But of course, if half our customers haven't actually paid us, then although we brought the total sale in arriving at profit, the cash we'd have had would have been less. So we need to adjust for that sort of thing. We need to adjust first of all for receivables. Receivables, last year we were owed 75, this year we're owed 83. There's been an increase in receivables. Again, compare last year to this year. The receivables have increased, 83 minus 75, they've increased by 8,000. Now, although learn this, the more you see the logic, the less there is to learn. Surely if receivables are higher, customers owe us more money, we'll have received less cash. Profit 131, but because receivables are increased, the cash received would be 8,000 lower. Well, in exactly the same sort of way, for the same reason, we need to adjust for inventories. If we bought more inventories, we'll have less cash. And what's happened here? There's been an increase in inventories. It's gone up from 81 to 90, an increase of 9,000. And if inventories have increased, again, with less cash. If, of course, inventories had fallen, you'd have had more cash, or if receivables had fallen, you would add. Well, do it the same sort of thing for all current assets except cash, because remember the whole purpose of the statement is to explain the cash balance, and also for our current liabilities. Our payables. Here there's been an increase in payables. It's gone from 69 to 97, an increase of, I think, 28,000. And will we add or subtract? Well, if payables have gone up, we're taking longer to pay, we've got more cash, you would add. We've also got tax payable, but we'll deal with tax separately. So for the moment, ignore cash, ignore tax payable, deal with receivables, inventory, payables, look for the increase, decrease, and adjust as a result. And so what do we get now? Having adjusted for those, I get my cash profit to be 142,000. And that's known as the cash generated from operations. Well, there's the cash we've had from profits. However, we show three other things under this heading, because what happened to that 142 we got from profits? We couldn't obviously keep it all for three reasons. Firstly, some of it had to be paid out as interest. So under this heading we show separately any interest paid, and from the income statement we paid 1,000. What else? Well, of course, some of it had to be paid out as tax, so we show any tax paid. But remember, it is a cash flow statement, and so it's however much tax we actually paid this year, not the amount we were actually charged. And we'd worked out earlier, the tax paid this year was 49,000. And finally, under this heading, what else did we do with the cash? Well, there were dividends paid. And note 3 below the income statement tells us the dividends paid during the year was 16,000. And so finally, how much cash was left? 142 minus 1,000, 49,000, 16,000. 76,000. So we've now dealt with the first heading, and that's the longest one. I think you'll find the other two very quick, hopefully. But a net 76,000 from operating activities. Let's look at the second heading. The second heading is cash flows from investing activities. And I said before, investing activities are primarily cash paid or received because we've bought or sold non-current assets. Well, we did our working, so this is easy. We've had acquisition of non-current assets. We had to work out the figure, but what did it come to? 195,000. Remember, it's a payment, so I'll put it in brackets. But we also received cash from the sale of non-current assets. And look back to note 2. The cash we received from sale was 30,000. And so we had a net cash flow, a net payment of 165,000 for investing activities. Finally, the third heading, cash flows from financing activities. Did we issue any shares? Did we take or repay any long-term loans? Well, here we can tell from the balance sheet. If you look at the balance sheet, I hope clearly we issued shares. The share capital's gone up, so we've had an issue of shares, we've received cash. And how much cash did we receive? Well, share capital went up by 50,000, but also the share premium went up. Although for accounting we put the two amounts in the different headings, it must mean, must it not, that we received cash of 70,000. What about any long-term loans? Well, here there are no long-term loans. Have there been any non-current liabilities? Then again, if they'd increased, we'd have received cash. If they'd gone down, we'd have paid out cash. But here, no others, so simply a receipt of 70. And so, what's the net change? Here there's been a net decrease in cash flow. We've received 76, we've paid 165, we've received 70, a net increase of 19. And that should explain the change in the cash balance. So what was the cash balance brought forward? From last year's balance sheet, we started with 64. We've paid out a net 19. And so the cash balance carried forward should be 45,000. And is it? Yes, it is. It balances beautifully. And there we are. For the last time, you'll never prepare a complete statement. But make sure you are happy with each bit of it, because any one bit of that certainly could be asked. One final point, a small point, but there's one item on that statement which we are allowed to show under a different heading, and that's dividends paid. Dividends paid, the statement gives you the choice of either showing it under cash flows from operating activities, as I've done, or you could show it instead under cash flows from financing activities as a separate line. So it can be under either heading. Clearly, if you had shown it under this heading instead, those two totals would both change. But of course, the overall total will be unchanged. It's just presentation. So everything else has to go where I've shown it. Dividends paid, it's either of the two headings. Alright, well that's the end of that session. Go back, make sure you are happy, obviously. There's one more thing to look at briefly. We'll do that in the next session.